Everyone's looking for the explosion. Everyone's waiting for the fireworks. But while the retail crowd is chasing the next shiny pump and dump coin, Ethereum is doing something much more important. It's quietly testing the single most critical level of this entire cycle. Look at this. We are sitting exactly on the 618 Fibonacci level, around $3,060. This is not random. This is the line in the sand between a full-blown bear market reset and the continuation of the run to $5,000. The ghost chain narrative? It's dead. The sentiment is not just brutal anymore. The data is shifting beneath our feet. But there's a massive trap forming for the bulls who are not paying attention to the moving averages. Today, I'm not just going to show you the chart. I'm going to show you the 9 data points, from Morgan Stanley's latest move to Vitalik's rebellion manifesto, that prove why this or the next few weeks are the decision point. We are fighting for the trend right now. Welcome back. Ethereum is trading around $3,100. If you have been following the channel, you know we had a rough end to 2025. We saw that rejection at the descending trendline in October, and the market sentiment got heavy. But here's the reality check. We have not collapsed. We are seeing a stabilization that very few people are talking about. Price action over the last 2 to 4 weeks has been chopping, yes, but it is chopping with a purpose. We are holding above key structural support. The market sentiment has shifted from fear to neutral, but it has not hit greed yet. That is usually where the opportunity lives. The crowd is bored. They want immediate gratification. But smart money? They love boredom. They love compression. And right now, Ethereum is compressing. But before I show you the technical breakout structure that is forming on the weekly time frame, we need to understand why price is holding here. Because the fundamental picture has changed drastically in just the last 10 days. I went through the latest research reports and the social metrics from last week's, and I have compiled the 9 most critical updates you need to see. First, let us talk about the big money. Look at this bombshell from Morgan Stanley. They just filed for a spot Ethereum ETF. This is not just paper trading. This opens the floodgates for pensions and endowments to buy actual ETH. As Crypto Tice pointed out, this confirms Ethereum is being treated as a core financial asset, not a niche crypto toy. And the flows back this up. Eisenhower's data shows that Ethereum led all networks in net inflows for 2025, with $4.2 billion. This was not meme coin rotation. This was enterprise adoption. In fact, by Q4 of last year, Layer 2 transactions officially exceeded Layer 1 transactions. The scaling roadmap is working. Remember the Solana killed Ethereum narrative? Look at this chart from Token Terminal. 50% of all tokenized euros are currently sitting on Ethereum, not Solana. And don't get me wrong, I also have Solana in my portfolio, but the real-world assets are choosing Ethereum for settlement. Furthermore, stablecoin issuers generated nearly $5 billion in revenue from their Ethereum deployments in 2025 alone. Leon Wademan highlights that stablecoin transfer volume on Ethereum hit $8 trillion in Q4 2025. That is double what Visa processes. Let that sink in. Ethereum is doing double Visa's volume in stablecoins. The DeFi flywheel is spinning faster than ever. We just hit an all-time high for Ethereum deposited on Aave. This means people are locking up their ETH to use it as collateral, reducing the circulating supply. And speaking of supply, check out this update from CryptoHunts. The entire Ethereum staking exit queue is empty. 0 Ethereum waiting to leave. But $3.5 billion is waiting to enter. The last time this happened in July 2025, ETH rallied from $2,800 to $4,800. Finally, Vitalik just dropped a massive post for the new year. He's calling Ethereum the rebellion against centralized overlords. He confirmed that in 2025, gas limits increased, blob counts went up, and ZK EVMs blasted through milestones. The mission for 2026 is clear. Make Ethereum the world computer that survives even if big tech collapses. The fundamentals are confirming growth, but the price is whispering caution. That's a mismatch. And in finance, mismatches get corrected, usually violently. Now, let us see if the chart confirms this thesis. I'm looking at the weekly time frame because the noise on the hourly charts is irrelevant for a position trade like this. First, look at the Fibonacci levels. I have anchored this from the December 2024 high of $4,100 down to the April 2025 low of $1,390. Right now, we are sitting close to the 618 fib level at $3,060. This is the golden pocket. In technical analysis, this is the most common retracement level for a bullish continuation. The fact that we are hovering here and not breaking down is significant. If we lose this, the next support is the 0.5 fib at $2,700. But for now, the bulls are defending the 618 with their lives. This is a mess, and that is a good thing. We are currently above the 200 simple moving average and the 100 EMA. These are your long-term trend supports. As long as we are above the 200 simple moving average, the macro trend is bullish. Period. However, we are fighting the short-term trend. We are currently below the 10 and 21 EMAs and the 55 EMA. These are acting as dynamic resistance. The price is compressed between the long-term support and the short-term resistance. When price compresses like this, it signals a massive move is coming. It's like a beach ball held underwater. Notice the descending trend line coming from the August 2025 top. We got rejected there in September and October. We need to break this line to confirm a reversal. But look at the ascending trend line from the July 2024 local top, connecting to December 2024 and August 2025 local tops. This shows the possible next peak, perhaps in quarter 2, before a new correction for higher flights later in quarter 4 2026. This is the alpha. Now, look at the Heikin Ashi RSI. It was oversold. But look what happened with this recent move from $2,600 to $3,200. It curled up. It's leaving the oversold region. I have marked these spots with white circles. Look at history. September 2023 signal, 160% rally. September 2024 signal, 80% rally. April 2025 signal, 250% rally. We are getting that same signal right now. The relief rally I was expecting is playing out, and the momentum is shifting upward. On the left, look at the volume profile. The point of control is at $2,500. That's our floor. If Bitcoin dumps below 80,000, that is the magnet. But right now, we are building volume above it, which is constructive. So how am I playing this? No financial advice, just my transparency. I established my load zone back in December, $2,350 to $3,250. Price briefly wicked out, but we are back inside it. I'm actively accumulating in this region. This is where you build the position for the next leg up. I'm not chasing green candles. I'm buying the red ones and the consolidation. If you are a short-term trader, my invalidation level is $2,150. If we get a weekly candle close below 2150, this setup is broken, and I'm cutting the short-term trade. For my long-term hold bags, I'm not selling. If we lose 2150, I'll look to reaccumulate heavily around $1,700. But for the trade, 2150 is the line. I'm using a trailing stop methodology. Once we hit target 1, I move my stop loss to entry. Target 1 is $4,000. Target 2, $5,700. Target 3, $8,400. And target 4, $11,000. Now, I have to be realistic. If Bitcoin crashes below $80,000, Ethereum could lose my stop loss. In that scenario, I'll open a hedge short targeting $1,800 using low leverage, 1 or 2x, based on the 2-hour Heikin Ashi RSI overbought signal. Always have a plan B. So here's the game plan. The probability of an upside move is increasing because of the Heikin Ashi curl and the fundamental shift in sentiment. Best case. We reclaim the 21 EMA in the next 2 weeks, break the orange descending trend line around $3,500, and then it's a straight shot to test the $4,100 highs. Worst case, the market ignores the fundamentals or macro markets roll over. We lose the $3,060 support, grind down to the 200 SMA, and test my patience. But mathematically, buying at support with a stop loss at 2150 and a target at 5,700 gives us a risk-to-reward ratio of nearly 1 to 3. Those are the trades I take every single time. The chart suggests the quiet accumulation is almost over. We are currently sitting on the year's most critical support level. The data demands your attention. I'm watching this weekly close like a hawk. Smash like and hit the bell for alerts. For my daily insights, join my free Telegram in the pinned comment. I highly recommend you watch my previous Polygon video on screen now to understand the next rotation. Protect your capital, and I'll see you in the next one.